and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng is managing to hold on a very flat start. Nothing much of an up or down that we're seeing there.
I mean, the sell-off on Wall Street is a bit of a catch-up to the turmoil that we've seen, especially in European indices, etc. Yeah, Nifty is now flattish. We'll see if there's another wave of selling which hits, or is there any interest on the other side?
I think the key marker to watch for is the global bond yields. Now, yesterday we had the Japanese bond market blow up.
I think 26 has started off with a lot of news flow, a lot of concerns.
Post 12:30, you see some kind of recovery. For the time being, there's a bright red all across the screen.
Quite clearly a seminal $500 million moving out every single day practically after the market started in right earnest in 2026.
A ready 500 store access is what Cupid gets through this deal.
Because of the global events are the best time to invest in the markets.
What a massive recovery we saw around 12:30. A bit of it is sold into, but I don't think there are much complaints from.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Rima. In a short while, Prashant will join in as well. But it's that sort of a day for the markets. We were down close to 250 points odd. We've recovered a little bit, but still very, very skittish, Rima. And I think the story of the day is really the Indian rupee. That's not pulled back a good deal. Until we see weakness out there. You know, that's going to be a bit of a problem because those hopes of FI flows coming back, they go out of the window if you continuously see this rupee depreciation. From the day's low, it's pulled back a little bit. Yes, I know. But otherwise, even after this pullback, you have three stocks that are declining for one stock that's advancing. So you'll have to say the pullback that we saw today was from extremely oversold levels. I think on a closing basis today, if the bulls can at least conquer the 200 DMA on a closing basis, they'll feel a little bit better, but very, very skittish.
Indeed, and even the Nifty bank is under pressure, right? So while the frontline indices have managed a recovery, the sensex nearly 1,000 points from the session low, the Nifty bank is still down close to about 630 points. The advanced decline ratio is still in favor of the losing side. At peak pessimism, closer to 11 o'clock, we had an advanced decline ratio closer to 1:7. Now it stands at 2:5. So, but as you can see, once again, in the last 30 minutes, the gap between the two is widening. We've still got 1.5 hours of trade to go. It's been a roller coaster ride. The first half of the trading session, a lot of weakness. But in the second half, there has been a recovery. How durable is it? How much can it extend itself? Sandeep Tandon, founder and CIO at Quant Mutual Fund, is now joining in. Perhaps just make sense of the kind of moves that we've seen in the market since the start of the year. Sandeep, this is not quite the 2026 beginning that we were hoping for after the underperformance of last year. 3.5–4% lower now in a span of 14 trading sessions, and on the Midcap index, closer to 4.5%. And the rupee, that continues to weaken, 6 consecutive sessions of losses. How are you all at Quant assessing the weakness?
So if you recollect in your own program and market forum, I talked about that after a difficult 2025, we are entering into fragile 2026. And we talked about this year we'll remember as a PE contraction phase globally. Okay, this is what our macro analytics was endorsing, and it is moving in that direction where we are seeing PE contraction and we have seen a sharp sell-off happening in the expensive stock. So the way I look at it, the market is a phase which we have to live with that. Okay, we have seen very easy phase for last many years. If we are in a challenging phase, you have to rebalance and reposition your portfolio in such a manner that you can face these challenges and still generate alpha out of it. But we have to also understand in the context which we are in right now. Okay, obviously, logically, we are always bullish on the long-term perspective, but from a medium-term and near-term perspective, these are the challenges which we are facing. And it's not about India-centric. The challenges is more on the geopolitical front. There's a battle between US and China, and other countries are a part of that collateral damage which is happening, and it's a dollar supremacy. So it's a much larger thesis which we have to, if I have to sit down and discuss the macro, this is the way it's playing out. Now we have to play it very intelligently. Okay, when I say intelligently, let's understand if we talk about that, we are talking about a PE contraction phase, and why we are saying PE contraction phase. Let's understand that first. The most important thing is that the risk appetite, particularly in the global equities and developed market, has started shrinking. Liquidity cycle has also peaked out globally. So we are in a phenomena where we can expect the peak space can continue. Now, let's say how to take advantage of this situation. Obviously, the first thing is that we think that growth stocks logically will underperform and value will outperform. And within value, you have to identify the opportunity. So the way we have constructed our portfolio in today's context, the first priority is liquidity. So our portfolios are very liquid. B, safety is the second priority, and third priority is the return. That's the way we have defined the broader thesis. And within that, we are trying to identify all the stocks, let's say for what has not performed in last 1, 2, or 3 years, which are attractive, reasonably valuations are there. They're relatively underowned. I'm not saying you will find some completely underowned stocks right now, relatively underowned. And some of the stocks are now reaching with a frustration in the market and relatively hated zone. So these are the names which we want to capitalize. And given the trend which we are seeing globally, so I will be playing a very stock specific, and we're also playing from a short-term and medium-term perspective rather than saying everything is long-term.
So liquidity, safety, and then returns, right? That's the thesis you're going with, right, Sandeep?
Yes.
Okay, just one quick word then. The mid-caps, do you think they're going through a healthy shakeout? Or do you think there's a structural derating taking place on the mid and the small cap space?
So Nigel, let's understand, okay, last year or last few years, mid caps being the way AMFI defines mid cap is only 150 stock technically, okay? So when you have only 150 stocks and everybody is chasing them, and the extraordinary money has come to the mid and small portfolio schemes in the mutual fund also, and global also people were chasing. So obviously the valuation of the mid-cap space particularly has been very, very stretched. Okay. And if that is the case, and we are talking about the contraction phase, then I think the derating in some of these stocks, which has become very expensive, and we have started accepting that this is the expensive names and will remain expensive from a longer term perspective. I think those are the names where we see vulnerability is very high. After, let's say, 40-50% correction, some of the names, somebody comes and tell me I will be buying opportunity, like the EMS space or something like that. But I think it's the beginning of that trend. Okay. So I don't see that this pain is over in the overvalued stocks. Now this challenge comes or the opportunity comes. How you use this opportunity? See, when market falls, everything falls. Okay. But when market recovers, the good stock will bounce back first. So we have to understand, the question comes how you define good. Every cycle is slightly different from the previous one. So this cycle, the way we looking at the market is all about how to capture these opportunity when, let's say today, yesterday, or last 3-4 days, we have seen good amount of panic happening, and market obviously has broken certain technical levels, which a lot of people track from a behavior perspective. And obviously when these levels start breaking, people started believing the structure breakdown. And there is no debate on that, but the structure of the market has become very weak. Now, we all understand, see, we there for just 6 months or 2 months from a portfolio when we invest from a longer term perspective. And we always talk about investors and asset class. Equity in asset class is long term and investors are long term. So we have to look at from a longer term perspective. I think it's a brilliant opportunity if you can switch your portfolio, rebalance your portfolio, and without any hesitation. You should not feel, oh, I am booking a loss now. I have seen this price at the peak. Now it's down 30%, 40% from the peak. And this is the where psychological games comes into picture. People are not able to book profit. What we have to look at, okay, even 30% correction, whether this stock has potential to bounce back or will give me that desired alpha. If you are not seeing, given the environment which I'm talking about, I will like to rotate. This is what exactly we do at Quant, okay? And we do it ruthlessly in that sense, because the moment you bring your emotional attachment, association, then the problems start. If you are convinced about the cash flow, if you're convinced about the valuation, convinced about this is opportunity from long term, then you have to switch to these names and get out from the all most expensive and over admired territory stocks.
Sandeep, we'll chew on that thought, but request you to just hold on for a moment because we have Harmis and Sonal, both of us joining in, to just put light perspective on the broader market pain that we've seen and what investors should be watching very closely. Harmis, you go first.
Well, you know, when you usually see such kind of moves across the year, but we are just first 2 weeks into 2026 and we are already witnessing the extremes of the market. You take a look at the Nifty, down 4% as of now. The Midcap index is down 5%. The small cap index is down 6.5%. Just to jog your memory back, the small cap index was down 7% in all of 2025. It's down 6.5% in just the first 2 weeks of the year. Now, to take a look at stocks that are down more than 10%, 4 of them on the Nifty, 25 of them on the Midcap 100 and 33 of them on the Small Cap 100. So almost a quarter of the Midcap index and a third of the Small Cap index has stocks trading 10% or more lower. Now you break it down into a slightly broader gamut of stocks on the Nifty 500. Here too, 430 stocks are trading with negative returns on a year-to-date basis. Now on a returns front, if you take a look at the number of stocks that are trading with losses of more than 20%, already there are 11 such names. Almost 300 stocks are trading with losses of anywhere between 5% to 20%. That's the kind of fall that you're witnessing in the broader markets right now. It's not as if everything is down. There are some outperformers as well. You take a look at least 7 names, predominantly mostly metal names that are up at least 10% or more so far. Now you take a look at the underperformers. Tejas Networks was the worst performing stock last year. It's continuing that in this year as well. Cohance, Godfrey Phillips, Newgen, Elecon, all of them down anywhere between 23 to 25% so far this year. Now the outperformers. We spoke about Jindal Saw over the last couple of trading sessions. Metal names, Nalco, Hindustan Zinc, PSU banks have done well as Union Bank, and Emcure Pharma too finds the name in this list of outperformers. Now going on to the BSE 500, and here too 425 stocks trading with negative returns so far in 2026. Breaking it down, 14 such names are trading with losses of 20% or more, and even at least 300 names in this index as well are down anywhere between 5% to 20%, and there are 8 stocks that are trading with gains of more than 10% as well. Here the list of underperformers is even more stark. Allied Blenders is down 30%. CE Infosystems or MapMyIndia, one of the most touted IPOs, is down 25 already. HBL Engineering, Signature Global, the entire real estate space has been smashed so far this year, and Sapphire Foods as well, after the merger announcement, has only extended its losses if not more. So that's the kind of pain you're seeing in the broader markets. At the index level too, there is pain, but when you break it down into specific stocks, that pain grows even louder.
Okay, all right. Thanks a lot, Harmis, for that. All the complete list of stocks. But let's also focus on the performance of mutual funds in 2026. Sonal is here to decode the pain in the broader markets and how it's impacting the mutual funds. Sonal, I want to listen to this.
Thank you so much for that. But at the outset, I just want to say that before investing in any mutual fund, the YTD return or one-year return should not be looked at. But yes, since we're talking about this massive mid and small cap fall, that is seeing an impact on mid caps as well. So in the small cap segment, we have LIC mutual fund, which has seen an 8% decline year to date. It's a 16% decline in last 1 year itself. It's followed by Motilal Oswal small cap fund. There's Quant small cap fund, JM small cap fund, which is down around 12.5%. There's Quantum small cap fund, which has fallen lesser. It's down 3% year to date, and Sundaram small cap fund falls in the same category. It's down 4% versus other funds which have seen a bigger fall. And Quantum and Sundaram are these 2 funds which have actually seen a positive return in last 1 year, unlike the other small cap funds. So I just thought let's take the one which has seen the biggest fall and also take the one which has seen a positive return in last 1 year. So let's look at LIC mutual fund, small cap fund holdings. Harmis was talking about Allied Blenders being a big decline, seeing a big decline in last few days, and that is a stock in this particular fund. We have Apollo Microsystems, there's Precall, Naveen Fluorine, Sirma SGS Tech. This is one stock also which has seen a sharp fall. On the flip side, Sundaram small cap fund has seen a positive return in last 1 year. That has the likes of RateGain Travel Tech, there's Apple, Craftsman Automation, PNB Housing Fin, SGS Enterprises and EID Parry. Let's talk about the mid-cap funds because they've not fallen as much as small-cap funds have fallen in last 1 year. In fact, some of them have seen positive returns as well. So we have the likes of Corn mid-cap funds, which is down 7%, Helios mid-cap funds, which is down 6.3%, HSBC mid-cap. But these are also the funds which have seen some positive returns. For instance, Mirae Asset mid-cap fund has seen return of 10.5% in last 1 year. We have HDFC mid-cap fund, which is up 10% in last 1 year. Again, we do the same exercise, look at holdings of some of these funds. For instance, Quant mid-cap fund has Premier Energies, Tatacom, there's Auto Pharma, IRB Infra, to name a few. On the other side, we have HDFC mid-cap fund. Hormus spoke about Union Bank being a big gainer. That comes into this list. We have HPCL, which is up 30% in last 1 year, Indian Bank, Coforge, to name a few. Now, let's talk about the cash holdings by some of these AMCs. This is as a percentage of their overall AUM. PPFAS tops the list again. It is around 22.3%. It is followed by Quant MF, which is also sitting on cash holdings of around 12.6%, followed by White Oak, Motilal Oswal Trust Mutual Fund. HDFC MF has around 6.8%. Quantum MF also has some cash holdings. So this is just to tell you that, of course, the broader market fall has impacted mutual fund investments as well. And these are some of the top funds in that category.
Thank you very much, both Hormus and Sonal, for that. Sandeep, let me just take up one of the points that Sonal was talking about. The Quant Mutual Fund has a cash holding of about 12.5%. Is that correct, or is that as of December and in the last 2 weeks you all have been deploying?
No, it is marginally improved only. So it is not declined. Actually, we have booked some profit. So it's the cash level has actually moved up.
Okay, got that. And just, we started this discussion talking about the broader macros in the global markets, etc. I mean, now the big risk is that maybe the global markets also there could be a trend reversal. Maybe they will also correct, because up until now, the mother market, US, has been very resilient. There may be some complacency in the way they have digested everything that's been thrown at the market. How big a risk is that globally there is a shake-off?
So this is the point which we have been highlighting. The worry is not India. My worry is global market. My worry is US. And my worry is even NASDAQ also. Okay. So all this AI stock, which has done extremely well, I think that is the risk. And I said on the forum, I talked about NVIDIA could be the best shot for this year. Now, the way we have to look at is that obviously India has underperformed for last 6 quarters or so. We had a negative correlation in this market, which means if global market corrects, we can also correct a bit, which is the case right now. But what is very important is that we have a probability, I will say, based on our analytics, that India in 2026 will outperform the global market, which will be the inverse what we have seen in the past. So it's a very important takeaway with a lag effect. Money will shift to India. It's a very normal thing, if your risk appetite is peaking out in these markets and India risk appetite is on the lower side and it has been lower on lower levels for a while, I think money tends to shift. It may not shift on immediate basis, but with a lag effect of quarter or month sometime, maybe let's take a quarter sort of thing, then I think money will shift to India. So if somebody asks me, how you see year 2026, yes, challenging, but whether it can give you positive return if you have patience, the answer is yes, India will outperform. And if you construct your portfolio, some of the areas which we highlighted, you have potential to actually generate alpha out of it. Only thing is that you have to get out of your personal biases which you have built or last 2 years from the stock the sector has given. So people are still carrying those memories and say, this is the stocks which have done extremely well, and these are best performing stocks or sector. So I will look for buying opportunity. That may not be very effective this year.
All right, Sandeep. So you're talking about a PE de-rating, possibly that, PE contraction, actually. The globe could be in a bit of a flux. NVIDIA could be one of those top short calls, but India could relatively outperform if you have some patience and in the coming quarters, if the flows do come back. That said, Sandeep, if you have to turn decisively positive, what would that trigger be? There's this hope of the trade deal. Number-wise, it doesn't mean so much, but sentiment-wise, it means a large deal. We have the budget that's coming up. And obviously, the hope is that earnings actually return to the low teens to mid-teens. So if you return decisively positive, if you could state down a few factors on our markets.
See, first of all, the trade deal, obviously, it's a less important from numbers perspective, but more important from a behavior perspective or psychological perspective. It's something which is hurting and disturbing. But let's say what can change, okay? So I have highlighted this year the risk will be on the dollar value where dollar can spike, which can affect global equities. If dollar continues to remain weak and this call which we are making fails, because right now this year is all about dollar supremacy battle, which we are seeing with what we saw in Venezuela, what is happening in the Middle East and some of the areas. This is the pain point. If that thesis fails, that risk does not play out, then that will be act as a big trigger for equity market and emerging market in particular. That's the one trigger. Second thing, if government does something drastically, okay, on the taxation front or the budget, which I don't believe so, but if something like how GST thing happens, and if that is the case, and they can do some changes on the long-term thing, which is the expectation from the market, that can be a game changer. But does not look like, because government has been very clear how to make changes in from both long-term and short-term and different asset classes. And third most important trigger obviously is about earnings. We believe that September to December quarter earnings have bottomed out, including the tech space. So base effect will also play a very important role. The second half, which we talked about, will be slightly better because of the GST and the tax rationalization. So I think going forward, I'm more optimistic on the earning cycles, which will pick up actually as compared to when we turned negative in July 2024. We thought that the cycle has peaked out and it played out quite well. So I think we are again in the early stages. The key driver for the market is always about earnings. And if you believe that earning momentum can gather up, or certain sector, certain pocket where you see visibility, let's say sector like energy space or the banking space or the insurance space. So many sectors are there where we have seeing a clear signs of visibility in terms of earning expansion, and the P are not that high. Rather, we can see a peak expansion also some of these names. So I think that then you get a winner in these space.
Okay, all right. So, in terms of themes, you're talking a little bit about banking, pharma, energy as well. And I recall when we had the forum, I'd asked you if you had to buy between two stocks, a staple stock at 50p or an EMS stock. Between the two, it would be staples. But otherwise, if you to pick up your top theme where you all are relatively overweight in comparison to the index, which would that theme be?
Right now, we are significantly overweight on financial, and within that, banks, the private sector banks, because we think public sector bank has played out the opportunity now in private sector banks, and insurance company, which are in the deep neglected phase.
Okay, banks and insurance companies.
And in the mid and small cap, you gave the broad framework on how one should construct their portfolio. But can you break that up into a little, sub-themes or segments? Which ones do you like? Which one? I know it's a lot to do with individual stocks, and you've spoken, at length about that's the way to generate alpha in a challenging market like this. But just some broad ideas in terms of a sectoral tilt to mid and small caps?
So in some, obviously, if we're talking about, let's say, pharma as a theme or power as a theme or consumption, like Nigel talked about FMCG, so you have to drill down in 95 stocks in the mid and small also. There are many stocks which have been neglected for a while. They have their earnings, because of earnings compression, they have corrected a lot. And with the GST benefit, we believe there will be a potential on that side. So which means you have to dig and you will get some opportunity, provided you should have some amount of patience, But the challenge in the industry market is people who are so used to in last many years for the quick returns, and which you don't get, then people tend to get frustrated because the markets are not working. So if you go back and say we used to be very happy with 12-13% CAGR numbers, so you have to bring down your expectation, and the market looks good from a medium to long-term perspective, provided we are also willing to change our mindset and our approach in identifying the sector or stock, and because the expectation level has been significantly high, and that is something has to be toned down.
Okay, all right, Sandeep. Well put, and a good note to end this conversation on. I think that 2020 to around 2023 odd mark, at that time people got very used to that 15, 20, 25% returns. So moderate your expectations, and then in fact, the markets could actually look up from here on. Appreciate you joining in, Sandeep. Wishing you a good rest of the day, and we'll catch up soon. Thanks for joining in.
Yeah, thanks for inviting.
Well, time to slip into a short break. On the other side, we'll turn the focus on Kalyan Jewellers and Eternal. They're some of the top stocks that are moving around.
Welcome back. Still tentative for the markets. Indices are down close to about 0.4%. This would make the third consecutive session of declines for the equity markets. But as that intraday chart will tell you, after breaching that psychologically important mark of 25,000, going all the way down to 25,900, there was a remarkable recovery between 11 and 1 o'clock. But now, markets are still looking a bit iffy. Midcap index down 1.5%. How should you position yourself then in the last hour of trade? Mitesh Thakkar is now joining in. Mitesh didn't quite get to that 24,400 mark to initiate a fresh short, but it's been all over the place. Very, very volatile trading session. What's the trade that you've taken today or you recommend?
So, good afternoon. I think the idea remains that, we have a strong chance of heading towards 24,650, 660 zone, thereabouts, give and take a few points. Also is the fact that now I think the marker on the upside has shifted to 25,400, 25,380. I think any bounces closer to that level would be a shorting opportunity. And until we start getting closing above 25,400, 450, I think I would maintain a negative stand. So still a weak market for me, despite the fact that, my sense that some kind of jump is also coming from the fact that the PCR was extremely oversold in the morning at about 0.58. It will still get oversold. So I think there's still a chance of a bounce back coming. But again, the structure is weak, so I would not want to go low. But I think once the bounce back plays out, around 25, 350, 400 zones is where I would explore shorting opportunities. On the stock side, sorry.
No, that's it. We want your stocks well put in terms of the setup. And you've been maintaining that, right? That you're not very confident that the market's going to bounce. And now you've given us that level as well, 25,450. That's a crucial mark on the upside if you have to feel good. Otherwise, slippy slide to around 24,650. Individual stocks, Mitesh, go for it.
I have a sell on Indus Tower with a stop at 421 for targets of 400. And BPCL is a sell with a stop at 357 for targets of 335.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Mangalam. He's here to tell us about Kalyan Jewellers. It's lost its sparkle today. Mangalam, tell us more.
Not just today. In fact, Kalyan Jewellers is down for 8 straight sessions. And today it's down in double digits. If you look at this week itself, the stock's down over 15%. And from its peak, it's down over 36%. The important part is that, there are 3 major reasons why the stock could be lower. One is that the churn that has taken place at one of its top fund holdings. So if you look at Motilal Oswal Midcap Fund, that held about 6.3% stake as of last December, that stake has increased to about 9%. If you look at other institutional investors, Franklin has maintained its stake at a little over 1.3%, whereas Sundaram Midcap Fund has decreased its stake to sub 1%, which is why it's not visible in the latest shareholding pattern. And the government of Singapore too, their stake has come down from about 2% to 1.75%. So churn in some of the largest shareholders of the company at the top of that is something that's spooking the street. The other part, with the stock having declined, remember the promoter stake, which is at a little under 63%, 25% of that is pledged. Remember, this number same time last December was around 19%. So over the last 1 year or so, the promoter pledge on its stake has increased from 19% to 25%. Remember, in August 2024, the promoters had bought about 2.5% stake from Warburg Pincus at 535 rupees. That's when the pledge on their stake was created. So with a big decline in this stock, could there be some of those incremental pledges being called for? And as a result of which, could we see further downside on Kalyan Jewellers or not is the big question. And this question is important because nearly 6% of the company's stake is held by retail investors. 5% was the number same time last December, and now the numbers moved to 6%. And if you look at the number of retail shareholders as well, it's grown by about a lakh, 5.59 lakh last December. Now that number has gone up to 6.6 lakh. The only thing that we'll have to monitor now from here on is that with this underperformance and the huge rise of shorts in the stock, does it go into F&O ban or not? We've seen periods of big declines in Kalyan Jewellers, and this is even more so at a time when gold prices are higher and all these companies are reporting stellar quarterly updates. So this is definitely more technical in nature than fundamental, and the stock continues to decline.
Got that. What about Eternal? Making big moves ahead of the Q3 numbers. Typically comes out by 3:15. Yep. So anytime now. Yeah, go ahead.
Anytime now. It's making big moves. And, just to put those big moves into perspective, it's up around 6% ahead of numbers today. But the stock from its peak has actually, despite having moved about 5% today, corrected about 23% from the top. The revenue that the street is working with, 14% quarter on quarter. Remember, same time last quarter, the second quarter, that was, there was a big jump versus estimates year on year because the company had changed its inventory model for Blinkit. So we have to be mindful of that. Look at the numbers quarter on quarter. The street's working with a 14% up move on the revenue, 15,500 crores. The EBITDA jumps by 26%. The number you're looking at is around 300 crores. And the net profit at around 102 crores. These are all numbers quarter on quarter because year on year, the reported results are not comparable due to change in Blinkit inventory model, which was earlier third-party inventory, now will be owned inventory. Food delivery, net operating or net order value should grow anywhere between 12 to 15% year on year, and Blinkit GOV will be up 120 to 130%, or NOV would be up 120 to 130%. Either way, that's the GOV that gets captured in the reported revenue because of the new models. I'll be looking at the trend for the food NOV growth and whether there is a decline in Blinkit's EBITDA losses despite the investments that they're making in quick commerce. Any commentary around gig workers will be very crucial. And another number that I'll be watching out for will be the cash balance on their books as well, as all the competitors have gone ahead and raised funds. Eternal at the end of the last quarter had about 18,300 crores of cash, which is pretty comparable to what Swiggy has post its QIP and what Zepto has as well, as per reports.
Okay, all right, Mangalam, thanks a lot for that. By the way, keep an eye out on a few stocks. I think there was some news on Raymond's redevelopment project in Badala with revenue potential, I think, of 4,000 crores or thereabouts. what volatility. The stock went into the green and it sold off quickly from there. I think the intraday chart should come up for you of the stock. The Raymond stock should come up for you on the screen. It was spiked up and it's come back down. So, it went to 455, back down to around 440 rupees. That's the kind of volatility you're seeing today. And Thangamayil Jewellers as well. I think it came out with a set of numbers. Immediately, the stock spurt up close to around 3-4%. And then it sold off. It was down close to around 3%. And as we speak, it's more or less flattish. So, big moves. Intraday stocks are moving today nearly around 6 to around 10%. And it's being considered a bit of a norm. Well, you've got some news at the bottom of your screen. JB Chemicals, Nikhil Chopra has resigned as a CEO of company. That's a transition, new promoter coming in there. I think that was more or less on expected lines. The street was expecting this to happen. Well, we'll take a break, come back, continue to focus on markets, and we'll focus on select stocks as well.
Welcome back. The conversations continue here at Davos 2026 as we count down to President Trump's arrival, which is now going to be delayed by a few hours on account of a technical snag, and he gets to Davos later than what was expected. But to talk to us about all things tech and AI and what that means specifically for Indian IT services companies like Infosys, joining us here in Davos, Salil Parekh. Always a pleasure, Salil. Thanks very much for joining us. You're fresh off a third consecutive quarter of a beat and raise. How confident do you feel now about 2026, given all the uncertainty?
So thanks for having me here, Shireen. I think we are seeing a good outlook for the next year. What we shared a few days ago, financial services, we see next financial year better than this financial year for us. Already in this year, we are starting to see discretionary work in financial services, which is good. I'll come to some of the other industries. And energy and utilities, we see a better outlook for next year than this year. Then we see a lot of work in AI. We've identified 6 areas where we see a lot of growth opportunity over the next several years. And some of that will start to happen next year. And then overall, as you mentioned, we had a good quarter, an increase in the revenue guidance, and a steady execution with our margin guidance. So we feel quite good going to next year.
Well, let's double down on this AI opportunity in the AI landscape. Salil, you're pitching AI, your enterprise here in Davos. That's the theme and that's your tagline here for Infosys. But what does that mean exactly? Now, if I take a look at some of the numbers that you've thrown our way, you say that over 90% of your top 200 clients, you're working with them on some AI project. You're working on about 4,600 AI projects today. But when you say AI, your enterprise, give me a sense of what this opens up for you as a revenue opportunity the next few years.
So there, Shireen, what we are seeing is, to give you a couple of examples, one in software development, which is our core area of activity, we see working with third-party agents and agents that Infosys has built, the ability to work with our clients, large banks, large utility companies, telcos, to increase the speed of doing software development and reduce the time. So a huge change. Another example we are seeing is a lot of companies have old technology platforms, starting even with COBOL. Now with AI agents that are available today and what we are building, you can compress the time and reduce the cost. What that does is many companies who are hesitant to take on those projects because of the economics are now doing those. We are actually working with some companies in executing that. So that's a new area of tech work which is available to us, which wasn't before.
Okay.
Now, these are not things which sound exciting, but they're big revenue opportunities.
And incremental new revenue opportunities.
Exactly. So these are all new revenue opportunities. In fact, in February, we will do an investor day where we will outline in a little bit more color what the specific revenue opportunities are.
Could you give us a little bit color before you get to your investor day on what these revenue opportunities could potentially look like?
So what we are seeing is a good set of these 6 revenue opportunities. Another example is in customer service, where we see a lot of AI agents working to change how customer service works, customer experience, even more than customer service. Then there is, we will also share, there are some places where there is a compression in revenue. What we are seeing across the industry in terms of tech services. And what we have started to see now is the growth opportunities larger than the compression opportunity over a number of years. And that's what we want to showcase in that investor day.
So what could all of this mean in terms of added revenue? I mean, are we talking about, $1 billion, $2 billion, $2.5 billion over the next few years? I mean, what could all of this size up to?
So for Infosys, we will outline that this will give us a growth opportunity over the next years. As you've seen, in the last few years, the growth has been lower. Now with the last 3 quarters, things are coming back. With what we see also on the economic side, I mean on the global GDP, we've seen, for example, the US GDP numbers have been good.
Yeah.
We hear that the interest rates will further come down. With all of those, we see that typically spurs tech spend. And then we have the AI opportunity. So those are the things we'll outline.
So what are the expectations now as people go into finalizing budgets? What are you picking up from the clients that you are dealing with in terms of what it could potentially lead to?
So there, what we sort of were discussing earlier, in financial services and energy utilities, we see our next year growth better than this year. The next year revenue better than this year. So that's already a good signal. The rest, we are still working through it. We still see difficulties, for example, on some of the retail, some of the telco, high tech. But on balance, as an overall picture, we see a lot of opportunity.
You know, again, and I know it's hard, but I'm still going to try, quantify this AI opportunity. I mean, what is the size of the market that you're going after, for instance, and what could we realistically expect you to deliver over the next few years when we talk about this big AI opportunity that you, your peers, everyone's talking of?
Yeah, so there, we will highlight that in this Investor Day by going into each of the 6 buckets. What we see today is more that the growth over the next 5 years is something we are looking forward to in making sure that if we pivot our work to it. So part of it is also making sure we make the right investments. We are putting a lot of effort into building out capability, building out the partnerships, and making sure that our own people are skilled in that area. And that will give us the growth.
So,
well, hard to quantify the AI opportunity as of now, but companies are preparing for it for the long haul, making the right investments. But back to the market, a sore point today is the continued weakness in the Indian rupee, touching new low after new low. And today the low was 91.73 against the dollar. Lata is now here to just take stock of the kind of foreign selling, the sentiment that's affecting the equity markets, and what the RBI has been doing. Lata?
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it. And that's the same thing. At the rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading selling of buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar rupee rate for the day. That added to the pressure. So we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment, the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so, about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
Thank you, Lata, for explaining that. As you said, it's a familiar story, what we've seen transpire in the equity markets, in the currency market. The rout in the equity markets and the persistent FI exodus is not hurting. Mayuresh Joshi from MarketSmith India is now joining us on the show. Mayuresh, in the last couple of days, we've seen markets indices give up 4-5%. Individual stock levels, it's been a fall of more than 10% in so many large caps also. How have you used this opportunity to rebalance your portfolio? Where have you bought? Have you trimmed your positions anywhere?
Afternoon, Rima. No, I think there has been quite a rebalance at Markets with India. I think we got stopped out on a few positions. We booked out on a few positions as well. But I think a couple of sectors which are still doing relatively strong, in our opinion, as we see our institutional software, Panray, exhibiting a few sectors showing very strong trends. One is within the consumption basket, FMCG players. FMCG players not only will act as a defensive basket in these volatile times, but with expectations of better numbers expected to come through in this quarter and the coming few quarters as well, both in terms of volumes and value. I think you can probably expect some element of relief happening on this front as far as the strength in PSU and mid-private sector banks. Our own sense is that numbers have been very encouraging so far. And going forward, again, I think with asset quality pressures remaining benign, capital adequacy remaining extremely strong, and expectations of stronger growth dynamics displayed on the balance sheet, I think a few of these players might actually exhibit strength. Metals had a strong show, specifically base metals. Our own sense is at this juncture, ferrous players might start making a bit of a comeback within the space itself. The drawback duties that have probably got announced in terms of safeguard duties will not only aid top-line growth, but also utilization levels should start inching up higher than 80%. With a lot of captive mines at the disposal of a lot of listed players within India, absolute reported EBITDA and the EBITDA per ton should start showing signs of improvement. Our own sense is if the EBITDA improves anywhere between 1,500 to 2,000 rupees, you should see an incremental 3 to 5% increase in terms of EBITDA. And on long-term averages for ferrous players in general, they used to trade at 6 times EV EBITDA. Our own sense is that they should come to a normalized level of 7.5 times. So I think these are the spaces that might actually do well for a mix of factors based on each individual sector.
Okay, all right. Got that. In fact, we want to talk a little bit about those ferrous names, but just pull up Dalmia Bharat. The numbers have come in, and they come in more or less in line with what the street was working with. So on the top line, we have the revenue number that's coming at around 3,500 crores approximately. That's more or less in line with what our poll threw up. And also in terms of the operating profit, it's ballpark around 17%. So on a year-on-year basis, that's actually been an improvement, which was on expected lines. However, on a sequential basis, there was some pain as well. The stock is reacting more or less flattish because in the last few days, the markets have corrected, but Dalmia Bharat actually has been unmoved. The reason is that in the coming quarter, the street believes that things will improve from here on, and East India has seen a lot of pressure on pricing. You know, the pricing has down closer on 10% on a quarter-to-quarter basis. But now there is hope that there'll be some kind of recovery. So in the last few trading sessions, the stock had run up a little bit. But just to give you the numbers, revenue growth of around 10%, margin expansion of closer around 100 basis points comes in at around 17%. We'll try to get you further details. But for now, it appears more or less in line. The optimism is on quarter four's numbers. So let's see whether or not they can deliver. Pricing is good. Demand has been quite strong as well. And they've delevered their balance sheet. But since Mayuresh spoke about steel companies, well, let's tell you what Morgan Stanley had to say on steel. They've come out with a few stock calls. On JSPL, they have an overweight trading target price of around 1,250. They have an underweight actually on sale. 140 rupees is the target price out there. And they maintain their overweight both on Tata Steel as well as JSW Steel. And those target prices come up for you on the screen. The factors at play. They remain constructive on steel spread expansion from here on, which is good. The domestic steel prices, they have recovered significantly post the policy tailwind that we saw. So that's good news as well. You know, some brokerages have also written that we have seen price increases, but there's more to come, which is heartening to see because so the top line growth will be there as utilizations levels pick up and as pricing as well improves. From the China perspective, they say China's anti-involution is a medium-term theme. So that could be another tailwind because we know that China, they have been exporting non-stop close to around 10 million tons on a monthly basis. And finally, they're also going to say that the global macro factors remain supportive. So put all this together, Morgan Stanley, fairly optimistic on the prospects of steel stocks. Mayuresh, I think, you predicted or you preempted what I was going to talk about. So you already told us that you believe that steel will improve from here on. But tell us about cement. Dalmia Bharat has come out with its numbers, not expected to be any great shakes. But it seems the street actually is looking ahead from here on. They are saying quarter four is going to be good. Volume growth was good in December. That's continued in January. I have my ear on the ground and I believe that demand has been good. But what is heartening to know is that price increases have gradually been pulled back. And if this globe is going to go into a flux, you want to focus on domestic themes. So would cement be on your list?
Collectively, yes. Afternoon, Nigel, to you as well. I think numbers have been pretty much in line with expectations. I think the numbers which have come out so far, Dalmia Bharat, more or less in line, as you rightly pointed out. JK Cement was a decent set of numbers, as pointed out, and there are plans to probably take it to 40 MT over the next few years, in the next 3 to 4 years, probably seems to be on track. Therefore, our own sense is that as volumes improve, as realizations improve for the sector as a whole, with input costs remaining benign, and a lot of these players are doing backward integration as far as their power requirements are concerned, and the captive mines thereof as well. that would largely lead to a better EBITDA number on an absolute basis. And relatively, I think as leverage starts kicking in on an EBITDA per ton basis. The kind of additions that they've probably done, both in terms of quicker capacities in general for the industry as a whole, and generally capacity expansion, which are also close to either logistic or hubs which are probably more favorable for transport. I think that probably also ensures that efficiencies start kicking in. And therefore, with all these levers in place, I think the next few quarters should be pretty interesting for the sector as a whole. So I think, again, when we look at our EPS rating rankings at Markets with India, I think a couple of stocks which stand out. JK Cement from the Midcap Bank is a definite standout that we probably got. Among the large names, Ultratech probably remains on our watch list.
Quick word, Mayuresh. Restaurants Brand Asia, it's been a rank underperformer since its listing. In the last 5 years itself, share price is down 50%. But with a change in ownership, a fund infusion of 1,500 crore, would you bet on a turnaround and buy the stock?
Rima, not at this juncture, because I think it's gone through a terrible phase of underperformance. And numbers have been nothing great to write home about. And therefore, I think the entire re-rating of this stock will be based on numbers which will start coming through and consistent improvement on thereof, which will give the forward multiples something to speak about. But at this juncture, I think both these aspects are not in favor of Restaurants Brand Asia. So I think give it a pass at this juncture.
Okay, all right, Mayuresh, meet me for a burger. Sometimes it's on me. We'll decide the brand later. But thanks a lot for joining in. Have a good remainder of the afternoon, and we'll catch up soon. We'll take a bit of a breather on closing bell. Stay tuned. Abacus Assets, Aman Chauhan will be joining in on the other side. Stay tuned.
Welcome back. 30 minutes to go to wrap up trade. 25,150 on the Nifty. But what about the F&O positions and the trends? Nigel has now walked over to the F&O desk.
Well, Rima, we've seen a bit of a bounce, and the bounce has come from extremely oversold levels. But otherwise, the markets are still a little bit skittish. And I think first we need to see some kind of stability with regard to the Indian rupee. That's the key trigger from here on. We can't have this depreciation non-stop. Just a couple of months ago, we were holding at around 88, and now in no time, we're close to around 92, which is a bit of a worry. So that's one crucial factor. The VIX, it's spiked up, but it's still very far away from those fearful levels. So it's holding at around that 14% odd. I think the next mark on the VIX that the traders are looking at is around that 16, 17 odd mark. Till then, I think still believe that maybe in fact we could go through, get past this stage with a bit of consolidation. Here, the call writers continue, and they're having a blast. 25,300 call. Just take a look at the premium. It's eroded by close to 32% after nearly halving in the last 5 days or so. So that's now down to around 100 rupees. Pull up the 25,000 put. Now there, the premium has gone up by around 50%. Premium last I checked was close to around 90, 95 rupees or thereabouts. So there is some signs of writing on those levels. So the important mark will be today's low, 24,920. That's the first reference point, 24,900, 24,920. On the upside, going by the options data, and where we earlier took support, that will become a resistance now, 25,400, 25,500 odd. Individual stocks, though, they are doing a thing of their own. Samudra Motherson, that's actually seeing a mild short covering bounce in today's trading session. So good going out there. Eternal ahead of its numbers. There is seeing some fresh buying out there. So there is some built up on the long side out there. And finally, on Oro Pharma, that's one of those pharma companies, actually, they're seeing good amount of shorts that are creeping into the system. So there's a big surge in terms of open interest. The stock is down as well. The shorts are sniffing something. So for the time being, we live to fight another day. 24,900 is important. First reference point on the downside. A bounce in the lows, but not out of the woods. Back to you, Rima.
Thank you very much for that. Aman Chauhan, fund manager, Abacus Asset Manager, is now joining in. Aman, just earlier today, we had a chat with Sunil, and he was saying that he'll stick his neck out, and perhaps this is a good time to look at individual stocks, even, mid caps, small caps, large caps, which meet the criteria. So weigh in with your assessment of the kind of fall that we've seen, persistent pressure in the rupee. Where are we headed at a headline level, and what have you all been doing? I mean, particularly the portfolio that you manage.
Sure. As far as the rupee is concerned, even we are surprised negatively as to the way it has been depreciating, because on the economic side, things are improving. Trade oil is low, so it's not that something that we have a big pressure on the trade side. And hence, that is something which has been a worry for us also, because that dampens the sentiment across the board, right? And that is one of the major reasons why we are seeing the sell-off in the markets today. It's not that FI selling has happened just now. It has been there since some time now, right? So the panic that we see over the last 10, 15 days is not just linked to FI selling. Overall, the sentiment has not worked on, and people need trigger. We feel there's enough liquidity in the market. People are looking at market. They have the cash with them, just holding on. Once they see markets starting to stabilize, to move up, when they start seeing money being made, they'll all come in, and somebody has to take a call. And that's what Sunil mentioned, that some sectors, some stocks, they're down 30-40% from the peak. Definitely, what we did not buy earlier because of valuation reasons now seems to be back to 30-40% lower, and one should start to look at it. These are panic times. This is when somebody has to utilize or make good of the panic, and that's what he mentioned. That's what we believe in.
Hi, Aman. Good to see you in. Well, markets are tricky, right? But at these tricky stages, when you get the stocks that you want at your prices, and hopefully those prices are here. Otherwise, in fact, there could be further pain for the remainder of this year. That said, let's talk about a couple of sectors and themes. Banks, that's a consensus buy. Banks as well as financials. How are y'all approaching that pocket? Are y'all overweight out there, or are y'all underweight? And what's the preference between, private, public, NBFCs, or within that, there are a couple of themes like gold financiers, if you like?
So you can say we are equal weight to overweight. In some portfolios, we would be overweight. Preference is private versus PSUs, though we own top PSU banks also. Within financials, we also like NBFCs and across the board, including the capital marketplace. So we have some AMCs, some wealth management companies, some broking companies in the portfolio, continue to own them, like them. On the fringe, we have added to mid-cap banking names also in the recent times. And The outlook, as you all have been discussing, has been pretty good on this side, and you're right, it's a consensus trade and seems to be working as of now.
So these are the things that, themes that you like, but particularly in the last 15 days, where do you think the correction perhaps has come to an end? The valuation derating may have bottomed out, and you have actually bought stocks or themes. Can you give some more color on that?
Broadly on the EMS front, I think correction is more or less behind us. Things should start to look out. Cement names also, if the demand has to pick up from Jan, Feb onward, that's what people have been expecting, that ahead of the March and demand picks up, the government spending also picks up, then even cement stocks which have corrected have a good scope to move up. Metals have been doing well, so that's not, I'll not say there's a big opportunity there, though constructively we are pretty positive on that sector. With rupee continuing to depreciate, there can be a trade or there can be bonds in IT also, especially the mid-cap IT name, because then the growth rate is also pretty decent, right? So, and plus they benefit from the currency. So some mid-cap pharma names, they have corrected 20-25%. This is more of a quasi defensive sector. If you have a 25% drawdown in a pharma name, and there are some names out there which are corrected more than 20-25%, that clearly looks like a buying opportunity to us.
Looking at the Dalmia Bharat numbers, Aman, and as you mentioned, cement could be a counter trend. We have been just covering this out here, that with the globe in a flux, you want to look inward. And when you look inward, you want to see a couple of sectors that are actually coming off a rough patch. The last 4 months were rough for cement. Now demand seems to have picked up, both trade as well as non-trade, and pricing environment is improving. What will your approach be? I'm sure if you could name stocks, it would be brilliant. But otherwise, what do you like? The East companies, where pricing took the hardest hit and now they're bouncing back. Or do you like the large cap names, the big daddy? Or maybe you want to play some of these takeover candidates. How are you approaching the theme?
So we have the big daddies, when also we are centrally paced. We don't have a very clear preference towards east or north or south per se. For us, it's more of bottoms up stocks individually where we see earnings tractions better than what the industry will be. So in the portfolio is more of large names as well as some central names. East is also something that we like, but these stocks are not very liquid for us to get into them, and hence not part of the portfolio. So in a nutshell, more of individual names rather than having a preference for a certain region.
Okay, all right. Coming in late into the conversation, guys, but
jumping straight in.
Jumping straight in, right? And well, thank you very much for joining us, Amit, and good speaking with you. Well, I think D Street Chatter is next, and Nimesh is now joining in with what he's picking up. There's been a sharp recovery from the day's low. But at one point we were up 50 points. So at the day's high, the Nifty had bounced about 400 points. Some of that sheen is gone. But what's happening? Nimesh, take it away.
Hi, Prashant. A small bit of recovery in the last couple of minutes of trade essentially could be to the fact that there is an MOC buy basket at a leading FIDs. I spoke about this at 11 a.m. as well, that post 11 a.m. There was a bit of a pullback because of the margin calls got triggered in the first couple of hours, and there was a bit of buying as well. So maybe that's playing out in the Nifty, but broadly from a broader market perspective, there is a lot of pain and clearly signs of capitulation now. The mid-cap index is down another 1%, but there is a lot of lot of pain in the broader market stocks, the mid-caps and the small-cap names, and now there is clear capitulation from retail, HNIs, family offices, HNI, even for that matter, small PMSs and all. It looks like there is a bit of selling coming from those sides. So that's clearly in the broader market names. As I said, a small MOC basket buying, so maybe it will have an impact in the last half an hour of trade. But purely, there is technically we've broken some crucial support levels. So till the time it bounces back to about 25,450, doesn't look like there will be a very strong momentum for this market. Today, the buying seems to be largely in large cap names and a bit of selective into the PSU bank stock. So that was a color as far as flows are concerned. But I guess barring the Nifty pullback, the bigger pain seems to be in the broader markets.
Nimesh, anyone is thumping the table and saying this stock or that stock?
Very difficult, Prashant, thumping the table. People are...
Nobody's pointing to, this, look at this, look at that, and the stocks are being thrown away. No, nothing of that.
No, nothing yet, Prashant. People, there is a bit of scare now, clearly, the kind of sell-off we saw in the broader markets.
I think they're slamming the table and saying what's going on.
Nimesh, the other thing...
Today, Prashant, in the last 4 hours, I'll tell you, the feedback is every sort of investors had a bit of a relief. Ki, okay, I sold out and the stocks have fallen, so wow, it's a relief for me. And if there is a pullback, oh, there is a pullback, so there is a relief for me. So, you know, in both sense, it's just a small relief, but there is a lot of pain beneath. So I don't think anybody is right now in a mood to say thumping buy or give a thumping idea.
Yeah, no idea.
No idea.
But that is typically a good sign, right? I mean, no one. But you used the word capitulation a few times, and usually what comes after capitulation is a period of consolidation, and then maybe things start to look better. Has the rupee come up in conversations with
it has, Prashant. It has. So that also has an impact on the overall sentiment and the fact that, you know, FIs are not going to buy. If they're not large sellers, they're at least not going to come and buy India market. Also, the fact that, you know, a lot of dealers who advise the global funds, they seem to be believing that right now none of the global investors are in a mood to buy India market. There is so much momentum in Korea, other Asian markets, and they're doing so well that nobody's looking at India per se at this point in time. So clearly, India is out of the favor for the FIs. And what is the painful point is that there is a lot of capitulation from retail HNIs, super HNIs, and the newer sets of PMS and AIFs who have not seen this kind of volatility in the last 4 years.
Okay. Now let's get to stocks, because there are stocks, Nimish, right, on your list. What are they?
Oh yeah, so the first stock on my list is BEL. A bit of a contra buying is what I understand now from larger FIs, and especially when leading long-only fund seems to be, you know, accumulating in the last couple of days. Could be a play for the budget as well, because there is a bit of sense that, you know, there will be some focus on the defense side, at least in this budget. So that is something which, you know, at least some of the global funds seems to be playing. So that's clearly playing out in BEL. So that's the first name. But again, large part of my stocks are largely to do with the flows. So nothing much in terms of M&A. Large part of the M&A is what we've covered in the last many days. But so BEL clearly is one stock which stands out. The second name is HDFC Bank. Again, I'm saying a bit of contra buying because one, some long-only funds are active buyers, and also one of the leading family office has actually turned buyer in HDFC Bank at current level. So you know, the broad sense is, as I said in the beginning as well, the large flows are largely biased towards the large cap names and to some extent, you know, the financial names. So that clearly plays out. So HDFC Bank stands out in terms of flows today. Again, you know, Prashant, there is not much in terms of very delivery-based selling or very large delivery-based buying. It's very, very selective and very, very, very specific, is what I understand from a flow perspective. Raymond Limited is the other name. While you spoke about Raymond Reality doing good today, but in Raymond Reality, I understand one of the FPI holder who is a sovereign fund, they've been selling off late, and hence you're seeing a bit of pressure on Raymond Reality as well, Raymond Limited as well in the last couple of days.
And as I think Sunil Singhania was with us, Nimesh, no mention of the budget, right? By this time, it would be frenzy. Budget mein kya aa raha hai, ye ho raha hai, wo ho raha hai, nothing, zero.
Nobody, I guess, is right now talking about budget, Prashant. Everybody's looking at their own portfolios and crying.
Okay, all right. You know, yeah, but it's true. I mean, it's a powerful psychological feeling, right? When you sell and then stock goes down, well, the call was right. But then it goes up, and then you're, you know, you're thinking, well, maybe not so much. But you know, selling begets selling, and there's that feeling, I think, which is also, of course, crept in, that if this is going to be and it's been, I mean, at the day's low, it looked like, I mean, just add yesterday's loss and today's loss, it would have been an absolute slam dunk, waterfall kind of two days. Thankfully, we've got a little bit of a bounce. But, you know, that feeling that maybe there is more coming, maybe this is the start of another. India markets here have been correcting, but maybe for the first time, US has not seen any correction at all. Is this a global bit of a shakeout and things like that, with everything which is happening, all the comments we are hearing. So that element of fear, perhaps at the margin as well. Hopefully, things settle. There is that speech later tonight from President Trump at Davos. We'll see what comes out of it. We'll take a quick commercial break here. What to buy, sell today for reverse trades tomorrow. Mitesh is going to be with us for that. Stay tuned.
Welcome back. The other big development in the world of mutual funds is that Motilal Oswal's AMC Chief Investment Officer Niket Shah is all set to move to a new role as a managing director within the company's Motilal Oswal's group's principal investment business. Let's just quickly take a stock of the funds which are managed by him and which stocks those funds hold. Vinny is now joining in with the details. Vinny.
Hi, good afternoon. So talking about the funds that are managed by Niket Shah, it was quite a few over the years, more than a decade that he'd spent at Motilal Oswal as the investment officer. Now, Motilal Oswal Innovation Opportunity Fund, that's the lowest, and they have around 500 crores AUM as of now. Consumption Fund, 1,100 crore AUM. Arbitrage Fund, Business Cycle Fund, around 1,800 and 2,000 crore AUM there, while the bigger funds were the multi-cap fund, which has around 4,500 crore AUM, small cap fund that had around a 5,800 crore AUM, and flexi cap fund a 13,800 crore AUM, while a mid-cap fund, that was the largest one that was managed by him, was around 36,800 crores in terms of AUM. Now let's look at the returns. Most of these funds are recent in terms of the launches that have come in the last couple of years, is what we could say. Except flexi cap fund and the mid cap fund, they have long-term returns as well. So when you look at the flexi cap fund, in the last 1 year, obviously 1 year return is not something that you watch out for in terms of a mutual fund as a whole, but still 1 year flexi cap, mid cap funds have not done well. Previously 3 years they managed a 20% return for both these funds, while for flexi cap there's a 13% year on a 5-year basis, as well as for the mid cap fund it's around a 26% return for a 5-year basis. Now overall, other than that, all these funds just have a 1-year return. The stocks that they hold in these funds, talking about the top ones, which are the largest AUMs, mid-cap fund, Persistent System was among the top, holding more than 10% in terms of a weightage that came in. Coforge was there, 8.9%. We have 197 Communications, Kalyan Jewellers, as well as Dixon Tech among the top 5 holdings. Even for multi-cap fund, Persistent Systems, Kalyan Jewellers, as well as Coforge still are there even in the multi-cap fund. Other than that, there's Bharti Airtel as well as Shelley Engineering, which was among the top holdings. And Persistent System, Coforge, Kalyan Jewellers even makes the list in the flexi-cap funds. So these are some of the funds and large funds which they were holding with their stock holdings for them as well.
Okay, thank you very much for that. And some of them have done very well. A Coforge, Persistent, which are a part of the flexi cap fund, have given very strong returns over a 5-year period. For the day, the mid-cap index is down over 1%, managed to recover in the last 30 minutes. Credit Axis Grameen is a big mover. MRPL, 9% gain on that. J&K Bank, we chatted with the management earlier. At least for now, the QIP is not happening for the next 3 months. The bank will look at it in the first half of FY27. Stock is up nearly 4.5%. ITC seeing some interest, very large volume, stock up 4%. Sudeep Bandopadhyay, market expert, is now joining in on the show. Sudeep, thank you very much for joining in. Just wanted to get your thoughts in first on the 2 deals. One of them is Restaurants Brand Asia and the other one is Bazaar Style Retail and Cupid. Have you all done any analysis and is there an investment?
I think Restaurant Brand Asia wanted to, there was this deal in the market for quite some time. And I think it's good that somebody with some experience, at least in this entire space, has come in and acquired this stake. So it's good for this Restaurant Brands Asia. Overall, we are positive on the F&B industry. And we think there is significant scope for improvement of performance as far as Restaurant Brands Asia is concerned. We'll have to wait and watch how things pan out. But we are generally positive on this entire space. And of course, this has been very hot with a lot of deals happening in this entire space and pretty much a change of shareholding in almost all the branded food chains in the recent past. As far as Bazaar Style Retail is concerned, again, this is a space where we have been bullish for the last almost more than a year. We believe that this value retail is an area where there is significant growth opportunity. If you look at analyze the bigger chains who were into luxury retail, their value retail business, they have all started value retail business, and that value retail business is what they kind of help them to grow and help them to expand, whether it's a trend, whether it's a lifestyle, whether it's shopper stop, all of them, Reliance, all of them have the value retail chains. But having said that, we believe that value retail chains operating exclusively in smaller cities and towns have a significant scope for expansion, and Bazaar Style Retail is one of them. this current deal, I think there are synergies and there are opportunities, and I'm sure this will be value accretive going forward.
All right, stay with us. Sudeep, coming back across to you, but let's get in Mitesh Thakkar, Bonanza portfolio, who joins us on the show. Mitesh, markets down 90 points, had a bit of a intraday pullback, but that got sold into. So tell us individual stocks, though, for a buy or a sell call.
So I have one buy and one sell, one BTST call and one STVT. On the STVT side is Laurus Labs. After a good rally, the stock is now showing first signs of correction. So keep a stop at 1001, look for targets of around 970. And on the buying side is JSW Steel. Keep a stop at about 1164, look for targets of 1190.
Thank you very much for that, Mitesh. Interglobe Aviation is seeing buying ahead of numbers tomorrow. December quarter was the quarter in which the airline got hit on account of a lot of cancellations, and then the airline had to issue refunds, etc. So numbers will be watched very closely. Get into a break. On the other side, more on the market closing. Welcome back. The Nifty is ending off from the session lows significantly. The low today was 24,900. So from that level, it's been about a 250-point recovery that we've seen in the second half of the trading session. But the Midcap Index, Nifty Bank ending with a cut of nearly 1%. Sudeep, open-ended question as we wrap the trade. Any stocks that are looking attractive now after the fall?
Well, I think from an investor's point of view who have 1 year plus time horizon, this is a great opportunity for picking up good quality stocks which have corrected significantly. I do like Larsen & Toubro. I think it's definitely worth picking up post this correction. I also like State Bank of India. I think, again, it's a great opportunity to pick up from a long-term point of view. As far as cement is concerned, I do like cement. But considering the overall risks in the market, I will stick to Ultratech, which I think is the best of the lot and the biggest of the lot. So I think some of these stocks definitely worth looking at current levels. Need not be picked up immediately, maybe picked up over a period of next few days because market is going to remain volatile now. But definitely good opportunity for building portfolio from a long-term perspective.
On that optimistic note, we'll thank you for joining in, Sudeep. Let's hope, in fact, this is that time that helps build portfolios and hopefully the pain is nearing the end. Thanks a lot for joining in. Well, time to wind down the markets. Last 60 seconds left. It was another day of trade where, in fact, the Nifty wobbled. We were down 250 to 60 points at one point of time. We did recover. The good news is, on a closing basis, we managed to conquer the 200 DMA. What didn't do well? The banks. They underperformed after a while. ICICI Bank did come in for some selling. So that was one of the top losers. Axis Bank as well was down in trade. What helped? Well, you had Eternal. The stock was up close to around 5%, and that was the top gain on the Nifty. It's corrected from 370 to around 280, but today it popped up in trade. Interglobe Aviation, well, the stock was up close to around 1.5%. Some kind of relief coming in with regard to that talk on capping fares. Besides that, metals did well. Hindalco as well as JSW Steel, both of them, ferrous and non-ferrous names, did pretty well in today's trading session. From the broader markets, Credit Access, Graham and Bureau.